Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Chris Panayiotou, certified financial planning professional, the Cap and Capitalize. And on today's episode, which will be a loaded episode, I'm going to tell you what you need to do with your company stock in the case of a company stock option. But as always, before we get into the meat of the episode, your free advice for the week. And this one's going to be short and sweet. Let your winners run, but not too much. Think about that for a second. Now, when we get into today's episode, and because I'm going to warn you, there is a lot that we're going to go over today because company stock options are not cut and dry. There's a lot of different, it's not necessarily a lot of different options out there because if you work for a company, you're going to get whatever stock option they give you. But there are a lot of different options out there that I want you all to be aware of. And so because of that, what I did is I broke up this episode where before the commercial break, I'm going to go through just all the different types that are out there. And then after the commercial break, we're going to go over the tax consequences because you could potentially save a boatload in the tax department. And depending on what stock option there is, each one of them have a significant amount of tax strategy that you can play with. And yes, tax strategy, it has its own section because taxes can just get absolutely wild. So this is definitely more of an advanced episode as opposed to some that we've been recording in recent past. So with that, we're going to get into number one. And just to give you an idea, there's a lot of different stock options out there, but what I'm going to go over today is about 6 or 7 of them that are the most popular. So in no particular order, we're going to go with number 1, which is the incentive stock option, ISOs for short. Now, who normally gets these? These are generally granted to employees, so not contractors or advisors, everyday employees. And there are a couple key features that I want you to be aware of with incentive stock options. So they allow the employee to buy company stock at a fixed price known as the strike price. And often that's the fair market value when the stock is granted to you. And there's some potential favorable tax treatment if you meet certain holding requirements, which again, after the commercial break, I'll give you concrete examples of how these work. So I'm just going to talk 50,000 foot with incentive stock options and the other ones to come. So the potential favorable tax treatments if you meet these holding requirements. Number 1, no regular income tax at exercise. It may trigger an alternative minimum tax. So if you don't have a CPA or an enrolled agent, you're going to want to get a hold of one. And then the second, if you hold it for at least 1 year after you exercise it, in 2 years after it's granted, the gains are going to be taxed as long-term capital gains, which is much more valuable than ordinary income. And with incentive stock options, they have to be approved by shareholders, and they follow specific IRS rules that are pretty rigorous. And even though the IRS, as of this recording, is basically shut down, there just aren't a lot of people there. They take incentive stock options very, very seriously. Now, one unique thing about incentive stock options is it's limited to $100,000 per year per employee based on the grant value date. So that's 50,000 foot view of what an incentive stock option is. Now, the second company stock option I want to talk about are non-qualified stock options. And those are generally abbreviated by NSOs or NQSOs for short. Now, who normally gets these? Employees, but also contractors, advisors, and directors can get these. Because again, unlike incentive stock options, non-qualified stock options, they're a little bit more flexible in terms of who can get them. And there's some key features that you need to be aware of. They're more flexible than ISOs, and not only are they more flexible in terms of who can get them, there are significantly fewer IRS restrictions. So these are more popular between the two. Now, it's taxed at exercise. So this is the difference between, again, the strike price and the fair market value, which is the spread. That is going to be ordinary income. And again, I just need to reiterate, we're going to go through specific examples after the commercial break. Subsequent gains after you exercise your stock are taxed as capital gains when they're sold. And this is often used for non-employee compensation. So for you all that are listening that have non-qualified stock options, you're going to want to make sure that your cash is built up a little bit more than those that don't, because even though you may not realize a lot of this income, that taxed at exercise, which will be ordinary income, will affect you come tax season. Number 3 is restricted stock units, RSUs. And I see this a lot in clients that work for publicly traded companies or late stage private companies. And those are generally who gets these types of investments, are employees. And a couple key features that you need to be aware of. You receive stock after it vests. So unlike the previous 2 we spoke about, there's no exercise that's needed. Once you vest it, you get it. Now, once the stock vests, that is taxed at ordinary income. So very similar to non-qualified stock options, you're going to want to make sure that if you have these, you want to build up some cash, because the tax liability, it's no joke in some cases. And you're taxed on the ordinary income when they vest based on the fair market value. Now, you could elect something known as a Section 83B election, only if you're granted restricted stock, but not RSUs. So just one little caveat in there. And the reason why RSUs are provided, they're often used to retain talent, and they're also pretty simple to administer. The 4th stock option I want to talk about is restricted stock awards, RSAs. And normally who gets these are either early employees or founders of companies. So these are admittedly just not that common. And in my career, actually, I've only seen a handful of these over the last decade. So they are out there, but I'm going to go over this pretty quickly because the majority of you, it won't be as pertinent. So you receive, the stock up front, subject to vesting. You can also file that 83B election, which for the majority of you listening, you're going to want to file it. There's very few cases where it makes sense not to file an 83B election. And when you file the 83B election, you'll see it once we go through some examples. The tax favorability is significant. So you can file the 83B election to be taxed at the time of the grant, which would potentially be a lower value. And that means that your future appreciation is taxed at a capital gain as opposed to ordinary income. And like I said, these are not that common. These are the most common in early stage startups when the share value is extremely low. The 5th stock option I want to go over are employee stock purchase plans. And these are actually pretty common. And most employees of public companies are the people that get these types of plans. And again, I actually see this in my practice all the time. And there's some key features that you need to be aware of. So the reason why employee stock purchase plans are so valuable is they allow employees to buy company stock at a discount. And what the discount is depends on the company, but it's usually 5 to 15% of whatever the price is. And that actually comes out of the payroll deduction of the employee. Now, there's two types of employee stock purchase plans. There are qualified, which are Section 423 employee stock purchase plans. And those offer tax advantage, and they must be very broad-based. But then there's non-qualified, which are more flexible, but there are fewer tax benefits. And that's all I'm going to say for now, because we can get into the weeds of that, and that can go above and beyond what is pertinent to this episode. And the discounts and what we call look-back features can enhance gains in a pretty significant manner. And that's where you see employee stock purchase plans getting the most bang for their buck. And number 6/7, there's technically two different ones, but they act basically the same, are stock appreciation rights, SARs, and phantom stock. So most of the time, well, not most of the time, the people that get these are executives or key employees, occasionally advisors of the company, but very, very seldom. So these are for the top dogs. And there's some key features that you need to be aware of with stock appreciation rights and phantom stocks. So unlike everything else we've mentioned, you don't receive actual shares. And again, the phantom stock, it's kind of like it's a ghost, so it's within the title. But stock appreciation rights, that can get a little weird and tricky. So instead of receiving actual shares, you get cash or stock equal to the appreciation in value. And this allows for the company to avoid dilution of ownership. And when it's paid out, it's taxed at ordinary income. And you only really see this with private companies that can't easily issue stock. So again, not as common, but it is out there. And so now that you know of all of these options that are like, is that a pun? No, it's not. It's literal stock options. All the different types of stock options out there. We're going to take a quick commercial break. And then when we come back, you're going to need to buckle your seatbelts because we're going to get into how the tax implications are going to affect each and every one of these. So don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. Now that you know what types of stock options are out there, it is time for us to get into the tax strategy with all of these different stock options. So we're going to go back and take it from the top with the incentive stock options, the ISOs. And here's the example. So let's say that you're granted 1,000 ISOs at $10 strike price. 2 years later, the company's shares are worth $30. So you exercise all of your options for $10,000, which is 1,000 ISOs times $10 a share, which means you buy at the original $10 price. The fair market value is $30,000 because, again, the price went from 10 to 30. So your paper gain is $20,000. Again, bought it at 10, it's grown to 30, paper gain is 20. So how does this work from a tax standpoint? There is no regular income tax at exercise. That $20,000 spread, it may trigger an alternative minimum tax. If you hold the stock, this is where it's really, really key. If you hold the stock at least 1 year after exercise, and 2 years after grant, and later sell it for $50 a share. The sale price would be $50,000. Again, 1,000 ISOs times 50, that's 50 grand. Your basis is $10,000. That $40,000 is taxed at a long-term capital gain, which is a favorable tax rate, anywhere from, well, some cases 0, but 15 to 20%, as opposed to ordinary income, which could be in the 30, like mid to high 30s if you're in a high tax bracket. Now, if you sold before meeting those deadlines, which again, I'm just going to reiterate, 1 year after exercise and 2 years after grant, the $20,000 spread at exercise would be ordinary income. And then any additional $20,000 gain after that would be the same type of capital gain. So with ISOs, it's really, really key to know about the 1 year after exercise and 2 years after grant. Because when you do that with ISOs, you get significantly better tax strategy with that. Now, there are actual ways to take that capital gain and defer, in some cases, completely avoid capital gain tax with different investment strategies. But due to compliance, unfortunately, I can't reveal those directly. So if you ever have any questions, you can shoot me a DM or email. Now let's go over number 2, the non-qualified stock options, NSOs or NQSOs. So another example, 1,000 NSOs at $10 strike price. When the shares are worth $30, you exercise and pay $10,000. So how does that work from a tax standpoint? The spread, 30,000 minus 10,000, so $20,000, that is ordinary income, and it's added to your W-2 immediately if you're an employee. Most companies withhold tax at the exercise, so you're not hit with the tax burden, but I would still make sure you have ample cash for tax season, and you want to check with your company to make sure they are withholding money, if they are withholding any money. Now, your new basis in the shares are $30 per share. And if you later sold at $50 a share, the capital gain, it's that 20. So 50 minus 30, $20,000 total. That's taxed at capital gain. Now, in terms of if it's short or long-term capital gain, you have to hold it for a year or longer for it to be a long-term capital gain, which is more favorable. If it's under a year, it's short-term capital gain, which is the same as ordinary income, which is not as great. So again, NSOs/NQSOs from a tax strategy standpoint, yes, they are more flexible in terms of how they're able to be given to employees, but they're not as favorable from a tax strategy standpoint. And again, you're going to get whatever you get, but it's good for you to know this, because if you're maybe negotiating down the road, going from company to company, now you can negotiate, oh, do I want ISOs or NSOs, things of that nature. Now let's get into restricted stock units, RSUs. So here's the example. You get 1,000 RSUs that vest in 4 years. So every year you get 250. So when the first 250 RSUs vest, let's say the stock is worth $40 per share. So the tax impact, that $10,000 value, which is 250 times $40, that is treated as ordinary income and is added to your W-2 immediately. Your cost basis is $40 a share. Now, if you hold it for a year or more for that long-term gain, and let's say it grew to $60 a share and you sold it, your capital gain is that $20 a share. $60 what it grew to, minus 40, which is your new basis. And if you sell immediately after you vest, you avoid all the capital gains in all of its ordinary income. So very similar to NSOs, but just slightly different due to the vesting. Now let's get into restricted stock awards, which Again, these aren't as common, so I'm going to go through this one a little bit quicker, but it is valuable for you to know. So the example, let's say you receive 10,000 shares of restricted stock at 10 cents per share. Because the majority of restricted stock awards, if you remember before we entered the commercial break, these are for founders or early stage employees. So 10 cents per share isn't all that crazy to think about. And let's say that when you receive these 10,000 shares at 10 cents per share, you file the 83B election right away. And that'll be key in a moment. So the tax impact when you file the 83B election, you pay $1,000 for the shares and you include $0 of taxable income since the fair market value is the price. Now you own the stock outright and all future appreciation is capital gain. So let's say 5 years down the road, the company is acquired at $10 a share. You would have $100,000 of sales proceeds minus your $1,000 of cost basis, great rate of return. You would have $99,000 in long-term capital gain. Now, if you don't file the 83B election, this is where it gets key. You would owe ordinary income each time your shares vest based on their fair market value at that point. And this could mean a huge tax bill later when the stock is much, much more valuable. So you want to file that 83B election 99 out of 100 times. Now with employee stock purchase plans, and for those of you that work for a publicly traded company, especially with anything in the S&P 500, the majority of you will have employee stock purchase plans. So this is very pertinent. Here's the example. You join in employee stock purchase plan that lets you buy shares at 15% of a discount. And that would be off of the lower of the price at the beginning or end of a 6-month period. Let's say your stock starts at $20 a share and it ends at $30 a share in that 6-month period. You could buy at $17 per share, which is 15% off of that $20 at the beginning. And the tax impact, it can be pretty valuable. So if you sell immediately at $30 a share, your $13 gain, which is 30 at the end minus 17, which is what you originally bought it at, it's tax ordinary income. If you hold the shares for at least 1 year after you buy it and 2 years after it's granted, part of the gain can be taxed at a long-term capital gain. And that's depending on IRS qualified disposition rules. But for the majority of you, part of that gain is going to be long-term capital gain. Now, the discount portion, that $3 per share, which was off of the $20 minus 17, that's usually ordinary income, even with a favorable tax treatment. And you got to think about it. You can't have your cake and eat it too. I wish you all listening would just pay like nothing in tax forever and your gross is your net and you ride off into the sunset. But the IRS looks at that and says, look, you're getting a discount on a stock that's already appreciated in value, and you're getting a discount kind of on top of a discount. So because of that, you are going to pay ordinary income. You're going to be better off in the long run anyways, but it's just something to be aware of. Okay. And again, anything between that 20 and 30, that's where the capital gain comes into play. And then last, but certainly not least, the stock appreciation rights in phantom stock. So the example, you receive 1,000, and I'll just use stock appreciation rights. Again, for the purpose of this podcast, stock appreciation rights and phantom stock, they're basically the same. So you receive 1,000 SARs when the stock is worth $10 a share. 3 years later, the stock is worth $25 a share and the SARs vests. So the tax impact, you receive $15 of appreciation times 1,000. So that's $15,000 in either in cash or shares. Because again, with phantom stock, you don't actually get the stock. It's either cash or shares. That entire $15,000 is ordinary income in the year in which you receive it. Now, there's no capital gains unless you later sell shares that you receive. And then it's only on, this is really key, it's only on the appreciation after vesting, which makes sense because if you haven't vested yet and you sell everything else that is unvested, you're not going to get it. So not that common. Tax consequences can be rather extreme on the SARS and phantom stock, because if you are a founder or an early stage employee, and chances are the company is not churning out a tremendous profit, so you may not have a lot of cash to pay that, you got to be really tax conscious when it comes to SARS and phantom stock. And again, like I said, with all of these, you can't control what you get. But now that you know of all the stock options that are available in the stock option world, maybe you could negotiate which stock options you would want based on your tax situation. Now, let me know if you want a chart of all of these breakdowns, because I know we went over a lot and it can get a little complex. So if you want a chart of these, head on over to capitalizepodcast.com, click on About Us, Contact, subject line, question for the Cap and Capitalize, and ask for the charts, and my team will do our best to get you those charts within 24 hours. So that does it for today's episode on what to do with company stock in your stock options. As always, I'm your host, Chris Frey-Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Frey-Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The S&P 500 is a stock market index tracking the stock performance of 500 of the largest companies listed on stock exchanges in the United States. Indexes are unmanaged and cannot be invested indirectly. Stock investing includes risks including fluctuating prices and loss of principal. Christopher Paniotu is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning.